Alrighty. Welcome back, ASAP Finance listeners.
Good to have you.
Always.
Back with another great show. Joined by my co-host Sam. How are you doing?
I'm doing pretty well. This is a special episode. This is our 10th episode.
Oh, it is? Oh,
Yeah.
shoot. I guess it says that right there on the slide. But this is an important episode because if you think about it, by the title, you guys probably know we're talking about like IPOs, mergers, taking companies public, difference between a private company. People don't even know what the stock market is, right? And you guys are probably wondering, like, do stocks just like appear? Like when a company is created, does it just automatically go on the stock market? Like that doesn't really make any sense. There's a lot of blurred lines there, but guess what? We're here to unblur those lines for you. By the end of this episode, you guys are going to know like how companies can go public, whether they already have a stock or they're joining another stock that's public, which is called a SPAC, which we're going to get into here shortly. And yeah, so let's hop right into it.
Sir. So, before companies are stocks and you can buy and sell them on the stock market exchange, they're private companies, okay? And private companies are a lot different than public companies in some ways. Mainly, since they're not traded on a stock exchange, they have to raise all their money from venture capitalists and angel investors. And they'll rely on the profit or the bank loans for their capital instead of raising money through issuing stock.
Right. And they don't necessarily, obviously, private companies, like bigger private companies that are like achieving bigger things, like if they're developing a software or something, they're going to have to raise money. But at the end of the day, if you start a lawn care business and you file for an LLC online, that's technically a private company as well. So you don't have to get investors. You could literally start with $500 cash and invest in a lawnmower and start mowing lawns or whatnot. And then obviously you can't trade them. There's investors which you could grow. Like for example, I think like when Facebook was private or like Square, you can invest in it when it's private, and then when it does go public, it's just insane gains because public markets are super inflated as far as their revenue and whatnot. And then there's also unicorns too. You want to tell them about unicorns?
Yeah, so unicorns it's a fancy term for a private company that's valued at over $1 billion, like in terms of the market cap. And there's a lot of these. It's crazy how fast the number of unicorns is increasing each year. People thought I remember listening to an podcast episode about this. They were talking about the number of unicorns, like how quickly they're growing each year, and it's like it's accelerating so quickly because there's so much innovation happening, and now there's well over there's hundreds of unicorns now, and it's crazy how fast they're growing and how big some of them are. Like you got like Stripe, ByteDance, SpaceX, like three of the biggest private companies in the U.S. and outside the U.S. And they're like $80 billion for a private company. That's just crazy.
Yeah. And ByteDance, they own TikTok, by the way. I didn't know that actually before Sam told me before we started this episode. But yeah, ByteDance is the owner of TikTok, and they're doing a lot of stuff over in China. And I don't know what else. Do they have any other stuff they're doing on top of TikTok? I'm sure
they own a lot more stuff.
Yeah.
But TikTok obviously doing crazy well.
Exactly.
I saw recently their ad revenue, or I don't even know what it was. Like their ad revenue was like more profitable than like Google ads now or something like that.
What, like their margins?
Something like that.
Yeah.
And it was crazy.
That is crazy for sure. And yeah, well, like what we were saying about the unicorns, it's crazy because there's so many people now, and like you were saying, like we're evolving so fast, and like there's so many startups that are just coming out of nowhere. Like the private industry is just blowing up right now, and it'll be cool to see like what companies like 10 years from now are going public that have been grinding private. And that's a good thing. Like you should follow private companies now, because you never know, like 10 years from now, if you are going to be able to publicly invest in them. If you're following them from the beginning, you might have more knowledge than just someone that sees it right when they go public.
Yeah, I'm pretty sure I completely butchered that. I think it was that the TikTok, like they're experiencing more ad traffic now than YouTube or than Google is.
That's good to clarify.
Yeah, I wanted to clarify that.
And then obviously there's not private companies. I mean, there's private companies, and then there's also public companies, right? So public companies, you guys probably know Microsoft, McDonald's, Apple, one of the big, like at McDonald's. You obviously know McDonald's. You might have not even known it's public, really, because like you just drive around and you all see all these fast food places. Like Jack in the Box is public as well, and then Burger Shack is also another public fast food place. You don't think like, oh, I can buy McDonald's stock and I can buy a Big Mac from them at the same time. But yeah, anyway, and then obviously there's Tesla and Amazon, a bunch of more that people probably know about.
Not even that, like instead of buying the Big Mac, if you like McDonald's so much, you could just buy McDonald's stock. And like that's one of those fun things when you're starting out, you're like, oh my gosh, this is a stock, I'm gonna buy it because I like it. It's so like fun, I guess.
Right. And that's honestly the safest way to invest too, because like as an investor, you want to like know what the product is, and you want to enjoy the product. Because if you enjoy the product and you want to pay money for it, there's probably other people out there that want to pay money for it and they're going to invest in it as well. But to get into like the technicalities between a private and a public company, basically when you like go public, there's the SEC, and they basically have to control like regulation for public investors. And when your company goes public, then you have to like report things to the public, because as far as like a safety thing, you don't want basically they want like to be as transparent as possible to retail investors and institutional investors even, because they don't want people just throwing their money in companies and you don't know how much money they're making. So they have to like file quarterly earning reports every quarter, which is every 3 months. And then they also have to have a board of directors, just as like two of the biggest things that they have to follow. We talked about board of directors in the Elon Musk episode. They're basically just like it's like representatives for the company, and they can make choices and whatnot. And then obviously the two biggest, geez, I'm getting tired. I can't talk. The two biggest are like for what you can buy stocks on are the New York Stock Exchange and then the NASDAQ. Those are just two common ones. Then there's other ways you can buy it, but majority of stocks are on the NASDAQ and New York Stock Exchange.
Yeah, and like obviously these are the well-known stocks, and then like stuff like penny stocks. Like if you've seen Wolf of Wall Street, they call them pink sheets because they're traded over the counter. Like they're not even on the New York Stock Exchange or the NASDAQ because they're so small, and like they're not even listed yet on those. And like another thing about like buying stock in businesses that you like, there was a statistic that if you bought instead of like it was like 10 years ago or whatever when the first Tesla Model 3 was released, if you had taken that $30,000 and put it in Tesla stock instead of buying the Model 3, you would have been like an instant millionaire.
I'm sure you could have bought a lot more Model S's and Model Ys. You could have bought every one of the cars if you just, but people don't think that far ahead. Or like but if you bought a Fisker when they first started, you would be sitting bankrupt. So that's both sides of the chain. And then also, yeah, the reason like companies go public is like to raise money. So like if there's a start, for example, SpaceX was thinking about doing this, but they didn't. And if like a company is running out of funds and they have to fund like a project or fund a service, and they don't have any money, one of the most popular options is for people to go public, and people can invest in the stock and you can lose it, or it might be a good investment and the company might go on to continue for years and years ahead. But that's just a way for companies to attract more investors instead of just private and institutional investors.
Yeah, and like obviously companies always want to raise money because I mean regardless, obviously like the really late stage companies like an Apple or an Amazon, they don't have to keep raising money because they're so mature and their profit margins are so crazy and they're bringing so much cash in. But like companies as they're growing, they're just burning through cash, always wanting to raise more funds from investors. So like whether they're private or public, they'll just do whatever they can to do that and keep doing it.
Right. I mean that's exactly just another thing on Elon Musk. If you guys didn't know, Elon he obviously owns Tesla, and then he obviously owns SpaceX. He's the CEO of both of those companies. And back like it was years ago, they were both about to go bankrupt, and he had like a certain amount of funds left, and he could either make the decision to put it all into Tesla, all into SpaceX, or split it between the two, and they could both fail. He spoke about this himself, and he literally split it into both too, and he took such an enormous risk. And then obviously Tesla is doing amazing, and then SpaceX is landing contracts from the government, and they're on the way to bring people to Mars. So just a cool story.
Yeah, SpaceX is like the perfect example of a private company that is always wanting to raise cash, because the whole business of SpaceX is just like building new rockets and all the other stuff that they're launching, and those cost like so much that they need all that funds from investors, those government contracts to keep going until they can start like turning a profit on some of that stuff.
Right. And you guys are probably wondering, if you do want to go public, what are the options for you to go public and raise money? Two of the most common are IPOs and DPOs, which are direct listings. They're very similar. Direct public offerings, they're basically DPOs, director listings. Say it, there's like 3 different names. They're the cheaper option. They eliminate like intermediaries, brokers, like in banks. Like, so if you were to go the IPO route, you would have to pay a lot more fees and a lot more people. And instead of an IPO, they create new shares, but a direct public listing, there's basically just already shares that exist. So for example, like if there's already the amount of shares outstanding in that company, for the direct listing, there's no new shares that are created. So however, like the amount of investors that are in there, are already going to be investing. I don't know. I'm not explaining that right.
I think that makes sense.
Okay.
It's just like, especially with an IPO, because there's so many people that already own like shares of the underlying company. When they're issuing the new shares, I mean, obviously a lot of IPOs will have the lockup period where they can't sell their shares, and like the direct listings aren't even subject to some of these rules sometimes, which means like, because there's so much more sell pressure, I guess is one way to put it.
Yeah.
I don't know. They're really similar, and that is the way like a lot of companies will go, like Airbnb and Coinbase, obviously two recent examples that did either one, and it's basically just they set a price, like it lists at that price, people can buy, and then it's live on the stock market.
Right. And then there's also, for IPOs, there's also pre-IPO investing. So like if a company decides to go public, you can sign up on websites and on Robinhood. I think they just added this as well, even though you should avoid Robinhood. I don't know why we're always plugging Robinhood when we say we should avoid it. But you can basically, if a company, you can buy the stock before it reaches the public market. So say, for example, Airbnb, I think their pre-IPO price was $68. So if you signed up online and you got in or whatever and you could invest, usually it's like it's mostly institutions, but if you got on, you could have bought Airbnb at $68, and then on the IPO day I think it like opened at like $160 or something crazy, and you're already guaranteed money. But like as Sam was saying, there's that lockup period, which is typically like 90 to 180 days, where after the public has access, like anyone has access to buy it on like the New York Stock Exchange or the NASDAQ, then you can't, if you get in at the pre-IPO, you can't sell it for 90 or 80 days. And then usually when that time is approaching, you see a lot of sell pressure when the lockup period is over, and the stock will usually fall a few points or percentage. But yeah, that's just important. Like if you see a company that's like an IPO that you want to get into, try to get in on the pre-IPO. But at the same time, IPOs are really successful like the past 2 or 3 years. But at the same time, it could literally tank the same time. So you really don't know.
Yeah, and that's another part where that difference comes in, because like with a direct listing, there's so much less scrutiny, I guess you call it, that you have to go through to be to direct list. IPOs are typically like more safe, because it's easier for a company to direct list than it is for them to do an IPO.
Yeah, and it's also guarantees like more capital, because if you get those pre-IPO investors, then you're guaranteed more cash, and then you're more likely, you don't have to wait like for the whole process, because usually it takes like 2 years. If you like initiate an IPO, you have like 2 years to finish it, and then it could not IPO, but then you still have the funds from the pre-IPO. So that's just something to keep in mind.
Yeah, and like with Robinhood and whoever else might pick up like the pre-IPO investing, it's crazy because like people are always, I mean, I say people, but like it's like this new generation thing. People saying like, oh, all these institutions, all these large venture capitalists can get into these companies so early. Like, why can't we get in early? And now like Robinhood comes out. I mean, we don't like Robinhood. Watch the Robinhood video. But like obviously new brokerages are coming out and saying, hey, we're gonna let like normal investors that don't have as much access to so much money, we're gonna start letting them get into like companies pre-IPO now, which is honestly kind of crazy.
It is awesome, like spreading the wealth, because obviously there's a lot of complaints like the rich just keep getting richer, and this is a prime example of them trying to fight that, and where everyday retail traders like us can get into early companies, especially in your Roth IRA, where you can really get that compound interest of like buying a company at like $10, and then it explodes 1,000-fold. Compared to like going public, and it's already starting out at like 100 compared to 10. So yeah, it's something that's cool. I'll look into it, but I don't know any companies that are IPOing right now. If an opportunity arises, definitely have to capture it.
Yeah, and I mean another way that companies go public that was like so popular last year is through SPACs. I mean, this was like the thing, especially the first half of the year. It seemed like every private company that wanted to go public, they would just go through a SPAC, and it honestly turned into some sort of bubble that started to burst with so many companies. Right.
And yeah, if another name for it is blank check company. So if you ever hear the term blank check company, it's the same thing as SPAC. I know, Sam, you're a big fan of Matterport, and I also Matterport is basically just like a 3D photo. It's big into real estate, and I think it'll be cool to see what they do with the metaverse as well. And then another one that I really enjoyed was Embark. They haven't, I think they just did a deal like 2 months ago, but there was an interview on Pounding the Table podcast actually I listened to, and he's like 26 years old, and they're building these truck AI, like autonomous driving trucks to basically like drive. They're trying to drive like 99% of the miles. So like instead of a truck driver starting like whatever back in the warehouse and then driving all the way to the highway. They're trying to eliminate the interstate driving. So all of that is going to be autonomous, and then they're going to drive to a station, and then from that station in like a major city, they can spread out to all the different warehouses, which I think is going to be super cool. And he's 26 years old, which is just insane. If he keeps working at this for 20 years, I think the title of the podcast is literally like the next Elon Musk or something. He literally could be the next Elon Musk if he's successful at it.
Yeah, and so like basically companies like these, when they go public through a SPAC, they'll be like the acquisition company will be listed on the stock exchange. I mean, for example, Matterport was GHVI, which was Gore Holdings. I think it was like Gore Holdings 6, and so they'll announce like, hey, we're taking Matterport public, and then they announce a date that they're going to complete the merge, that the ticker will change, and then it's listed and it's trading on the stock exchange under that new ticker. And last year it seemed like every company wanted to do that, and everyone was just piling to this spec, that spec, left and right, and then all of a sudden people realized like, oh, some of these companies aren't actually they're so early stage. Maybe we're getting a little ahead of ourselves. These aren't going to be profitable at all ever, if not for the next few years.
Yeah, it seems like the whole market was ahead of itself, not just for SPACs, but even like major companies now that we're seeing a pullback for, and it was just carrying over to SPACs because the macro environment and everything was just boosting these growth companies, and everyone was like, oh, Lucid Motors, and then the stock I think went up to like $60, and now it's like a third of the price it is now, which is just insane because they didn't sell any cars, and it was just all hype, which is basically what it was. Like, they have a rumor where a SPAC comes on, and they're like, oh, Lucid Motors might merge with this company or whatever, and then everyone just pumps the SPAC that's not even confirmed yet, and everyone's just doing the pump and dump scheme like GME and AMC. It was just the same thing, and then once the news came out, everyone sold it, and it was just insane to see that play out. But I don't know. I'll be interested to see like if that continues, like the hype around SPACs, because I mean, like 2021 they did $162 billion in raising money for SPACs, which is an insane number compared to like 80 million the year before that. So it's continuing to increase. I'll be interested to see if it follows in 2022. There haven't been any big names that I've seen.
But yeah, definitely be interesting to see. And I mean, similar, like obviously those are a specific type of like merger, acquisition, whatever you want to call it. But like more generally, other like more mature companies can do mergers and acquisitions, right?
Yeah. Yeah, so there's a difference between mergers and acquisitions. They're really similar, like Sam was saying. Mergers is basically just taking two companies and merging them together. Pretty simple, pretty straightforward. And then an acquisition is when another company acquires another company. They're pretty easy, but some people just they talk. People talk about them like in the same context, so it's good to understand the difference.
Sort of similar to like the direct listings and the IPOs.
Yeah.
A little bit of difference.
Tomato around here.
Gimmicks, yeah.
And then also, what was I going to say? Acquisitions. Okay, so like for example, a reason like companies like when they're sitting on a lot of cash, like Apple right now, and some other companies I don't know off the top of my head, they see like a company that they want to. Why you want to acquire that is because they see like their software or there's something that they're doing and they want to add it to their company. So, for example, Microsoft. They had a lot of cash on hand, and they bought Activision. They're a gaming. They do Call of Duty, and I'm a big fan of Call of Duty. At least when I was growing up, I haven't played too much of it now. Like Black Ops 2, Modern Warfare 3, Modern Warfare 2. Those are the best games out there. And they acquired Activision, and we'll see what happens with them. Maybe they might try make a play in the metaverse against Meta and Mark Zuckerberg. But there's a lot of companies out there that are acquiring video game people too as well. Yeah,
and I mean, in the subject of acquisitions. Normally, when a company acquires another company, they'll either set it as a stock acquisition or a cash acquisition. Meaning, so say Microsoft's like, we want to buy Activision. They'll either do it in an all cash deal. They're like, we're acquiring Activision for $50 billion. They buy Activision, and like I think in that case, every like owner of Activision shares, they can just sell the shares.
I think
I might be getting these mixed up.
I think it depends.
Because then in like the stock acquisitions, they're saying, oh, we're gonna buy Activision at a price of $80 per share, and then obviously if Activision is at $60 per share, that's a significant premium. Activision usually pumps, because everyone can redeem their shares, or the shares will be redeemed for so much higher.
And yeah, that's important you said that for the premium, because if someone's going to acquire another stock, it has to get approved by the board of directors, which are the shareholders in the company. So if someone's going to buy another company's stock, you're going to want to pay a premium for it, because if you're paying for the same price that it's at or even lower, why would the board of directors approve that if they're losing money on the deal, you know? And that's why Twitter, he bought it for like $54 when it was at like 30 or something, or $40. And that's just something to note. Like when companies are acquiring something, it's usually at a premium, and it doesn't make sense if you're ever holding a company that falls into an acquisition. Like say you were holding Twitter and they get bought out and it's at $54, it's around $50. It doesn't make sense for you to hold your shares for 2 years or however long it takes for the acquisition to take place, and then just collect that $54 instead of moving, because you're not going to get more than the amount that's offered for the company. So that's important to keep in mind. If you're holding a company that's getting acquired, you want to know how much money you're going to get, like from how long from now, and you might as well just sell it and place the money somewhere else if you do have that company.
Yeah, I mean, I think we went over a good amount of ways. Every way the company goes public for the most part.
Yeah, I heard ASAP Finance is about to go public in like a couple months. We're running out of funds to. We need an IPO soon. Pre-IPO at $100. I think we're valued at.
Okay, I can get behind that.
No, but yeah, Thanks for watching. Make sure you guys comment what you want us to see next. We got some guests coming up here soon. I know we've been talking about it for a while.
We promise this time. Tomorrow we're filming our first interview.
And guess what? We just finished exams. We're finishing exams this week, so we're gonna be grinding out and hopefully getting a lot better content and a lot more guests on.
We're going on a big trip here in less than a week. But after that, we might even start bumping up to 2 episodes a week if we can manage it over the summer.
Maybe get a little more of our Fiat series, Fiat series. There's a lot we can go into that, especially with the merge coming up later in the year. We got a bunch of topic facts. We got a bunch of topics we can dive into. But so just make sure you follow, leave a review so this podcast can grow, because we're really trying to get out to more people and get out to more guests. If you're listening to us now, you're ahead of the game.
Also, if you're just now finding us, leave a comment saying how you found us, because we have started a few methods. So we're just kind of curious what's working.
True. Good point. All right. But yeah, thanks for watching. We're not financial advisors. We may hold positions in the securities discussed in this podcast. Do your own research. And thank you for watching. Have a good one.
Catch you in the next one.